Welcome back to the Market Hustle podcast, where we cut through the noise, simplify investing, and help you build wealth without the hype. I'm Josh. I'm the guy behind the Market Hustle. And if you're new here, welcome. And if you've been with us before, if you've listened to a couple episodes already, we're glad to have you back. Today, I'm joined with we have two co-hosts here today. We have both Fernando and Bafi. Pierce wasn't able to make it to this one, but he'll be back in a future episode. Real quick, let's just see how our co-hosts are doing before we roll in and introduce our special guest today. Let's start with Fernando. Fernando, how are things going in Florida?
Everything's good, man. Grateful for every day. And definitely Florida gets kind of wild around this time of the year with storms, but all good here.
Oh, good to hear, Matt. Good to hear. It's good to have you back in the podcast. How is the weather right now at the time of this recording, where we're in August?
I think right now it's super hot, but it kind of feels like it's brewing to something coming, but we'll see. It's been a couple misses in the weather, but it's nothing new to me. That's for sure.
Well, good to have you back, man. Bafi, how are things going in New Jersey, my friend?
Things are good, man. About 2 weeks ago, I was in Orlando in Fernando's place. So I was around his neighborhood. My best friend was getting married, so he got married 2 weeks ago. So it's been a wonderful month. Came back up top, and I also just got married this weekend. So it's been very, very fun, exciting time. My birthday is coming up August 27th, which is insane. And that's the day that NVIDIA actually announced their earnings. So let's see if we get some good luck in the market for everyone. So yeah, really exciting month. A lot of fun activities, quality family time, great experiences. And so it's great to be back on the pod and get things moving.
Bafi, you've got a lot going on right now. I mean, first off, congratulations to you and your wife.
Thank you.
Huge milestone there. Happy early birthday. And I'm glad you're still out there enjoying and celebrating other people getting married with your friend group and everything. That's awesome stuff right there.
Yeah. Such a special moment for sure.
Yeah. Well, good to have you back. I know you've been busy, so it's been a little bit since we've had some of the team on the podcast. So great to have this going again. That being said, we've got a special returning guest I'm excited about, and that is Steph Guild. If you haven't already, make sure to go listen to episode 42 after this one. That was one of the first episodes we had with Steph. She's actually the president of Robinhood Asset Management and senior director of investment strategy. So I'm honored to have her back on the podcast just because she can share a lot of insights with us and help us all learn and grow as investors. That being said, let's just jump right into it. So Steph, how are things kind of coming along at Robinhood? I know you've had your hands full with everything from Robinhood strategies and retail investor trends we've been seeing. I'd love to hear kind of like what you're up to and where your focus has been recently.
Yeah, we've been, I feel like I continue to feel like we all have several jobs, not just one, because we are growing and expanding pretty quickly in terms of our product base. We have our second annual Hood Summit coming up in September. It will be like live in person for more than 800 customers attending, and it will be in Las Vegas. And we put it on the app. We're going to live stream a lot of stuff so you can watch it while it's happening. But that we will be announcing some new products for active traders and just new tools. And then and several other things, which I can't mention. And then we will also have the next day, a day of programming with different experts in fields of options, futures, just broad macro investors. And so we're actively working on that. We are also on all the products that go into that, because once they're announced, they start to roll out to live customers. I've also been working on Robinhood strategies. Obviously, we're managing assets for our customers based on what we know about them, and obviously taking into account the tailorization that customers like to see. And we want to expand the features that come with that. So I've been working on that, and we'll probably have more news later this year and then into Q1 of next year in terms of expanding the services there. And then I've just been out talking to customers, I was on Bloomberg TV yesterday morning. So doing those kinds of things. And there's a few other things we're working on that I can't even like mention the timing of it yet, but I would say that it could be, there's a lot of change coming from the president, and a lot of the executive orders that he signed, increasing regulation in crypto is making it more acceptable. And also just, if you saw the declaration the other day, like being able to expand the types of things you can invest in within 401ks is huge. And so we've been thinking about how can we help people with this expanded set or access.
That's lots of exciting stuff right there. Lots to unpack as well. Like you definitely have your plate full, Steph. And that's why I'm grateful that you were able to take the time to come talk with us for an hour to hopefully dive into some of these big events that are happening to help give us all some additional insight to help us understand it better, right? One thing that really stood out to me was that 401k announcement from the administration. Basically, and from what I understand it, correct me if I'm wrong, it's going to allow 401k plans to potentially give their customers the option to invest in more, I guess you could say, riskier assets, such as crypto, maybe even private equity funds. I'm not sure like how much you've gone down that rabbit hole with these 401k plans, but this could open up the opportunity for millions of Americans to invest maybe closer to a just more of an aggressive investing style that might fit their risk tolerance. Because like a lot of 401ks tend to be a lot of 401k plans tend to be fairly conservative, right? They're more like, hey, let's make sure you're in bonds. Like, let's make sure you're completely diversified, which is good. Diversification's good. But at the same time, it's like, if somebody's younger, they might have a higher risk profile, you know? So I'm curious to get your thoughts around that, Steph. Like if you've explored that 401k, like I think that's going to be a huge opening at allowing people to maybe customize their retirement plans to be more aligned with their risk tolerances and maybe even their investing goals.
Yeah, I mean, I think historically the view has been that you had things like qualified purchaser, accredited investor, right? And that's based on how much money you have. Qualified purchaser, you have to have at least be worth $5 million. Accredited investor is $1 million, or it's based on a higher income level. All of these things were, I think, set with the intention that like the rules should be such that these are riskier investments because they can be locked up. They are usually perhaps in companies that need to be turned around, for example, or are new ventures and may or may not make it. And so there's a view that like if you have, I think the view is that like if you have more money, then at the very least you can afford it if something doesn't go well, right? Like if an investment doesn't go well. But I think like when you look at the track records of diversified private equity funds, generally speaking, and not all of them, but the ones that were like median and above over time beat the S&P, were the right thing for somebody with a long time horizon. And what kind of time horizon is longer than somebody who's in their 20s and 30s and has a 401k plan that assuming they don't need to borrow against it. And so they're like, that's the thing, like the time horizon is right and matches well, but this access level, I think, was just thought that like, it might be too risky. But I think like as long as I think you're keeping it at the right bite size levels, like you don't put the entire thing into a venture fund, that I think the intention of the rules behind it was good, but the actual execution of it ended up, I think, just limiting the return opportunities for millions of Americans. And so I'm glad to see that there's a shift in that, but it doesn't mean that now we don't have to care about the risks. I think it just means like now we have the access and now we have to care for that.
Definitely. Yeah. You still want to be smart about it when it comes to how you set up your 401k. Like you said, don't put it all in the riskiest funds. Partially, that's why I really like Roth IRA accounts or just IRAs in general, is because you have a lot more flexibility with what you can select. With 401ks, you can't invest in individual stocks, but with IRAs, like a Roth IRA, you actually can. Like you can pretty much do anything with a Roth IRA account that you can with a regular brokerage accounts, which is,
Would you say, Steph, would you say this is like the beginning of a great wealth transfer where, because like 401ks, like you're a younger generation, you probably don't have as much as somebody that's been carrying a 401k for that long. So opening access to stocks or crypto is kind of like a wealth transfer. So those 401ks that are loaded with big amounts of wealth will start shifting into these different other areas instead of their private choices. Do you feel
like? I think, a couple of things. One is that right now in your 401ks, you can't do that, or you haven't historically been able to do that, or even own single names, is because there's still some responsibility by the plan sponsor. The plan sponsor is the company that's sponsoring the plan. And even though it's your money being put into it, they have some responsibility. And so I think it's kind of about risk. Like, is it worth it to them to give you the access? And then if you're able to put all your money into one stock like that, when something goes wrong, like I think they feel like responsible, right? And that's why they actually, a lot of those plans will come with like education and offer those like, hey, if you're retiring on this date, put your money on this, that's why, because it was like, what, let's not like let them take too much risk. In terms of the wealth transfer, like, it's funny, that word is used more so in like the wealthy boomers who like, accrued all this money over the years because they got the benefit of, falling interest rates and falling tax rates and all this stuff. And will it go to the next generations? Part of me has a theory that like they'll just spend it all and then nothing will be left for the next generations. But it could be part of it, because if you have a lot of money in a 401k, and let's say like you're fortunate, you're a fortunate person, you're retired, but you're like, I've actually saved so much money that like I may not even get to spending my 401k. That's when I actually think like you could, like that person could be like, you know what, I'm going to end up, my kids are going to get this. My grandkids might get this, they may inherit this. And so I should put it in things that are even long beyond my lifetime. And that's where I think it can be part of the wealth transfer. Otherwise, I think it's like, are these ways to actually help our population just better keep up with inflation, better keep up, like really make a step change in their retirement savings? Because even with tariffs and the government earning more revenue and them starting to get revenue shares in companies, right? Like this stuff is starting to be announced. We still have 39 trillion in debt, and we still have trillions of dollars in a deficit. And it means that something's going to have to be done about Social Security, for example. So like we need to give people ways to save more for themselves.
So that's an interesting point that you just made. And just out of curiosity, picking off exactly what you just said and where you landed, have you seen or heard anything within, whether it's policy making or companies that provide 401ks for the employees, looking to kind of implement, like, let's say, a small percentage within some of their fund options that they have for their employees, right? In terms of the crypto funds that are now can be invested into it. Have you seen or heard any talks about that being
actually happening yet?
Yeah.
No, I think it's too early, because I think like I was even asking our internal government affairs team, like, hey, does this include IRAs? Because sometimes like the Department of Labor, which governs 401ks, also can govern IRAs. And I was like, and they said not officially right now, but that may be the next step. But I think sometimes this is what happens. An executive order comes out and then a rule gets changed. And then it takes time to be like, what does this actually mean? Like, what are the new rules? Like, is there like all the details then get worked out in 100-page documents? And I think that's where they are before you implement it. A company will be nervous to implement before they know how, right? And that's, I think that's what's coming.
Yeah, no, that's awesome. I think that's actually good due diligence, right? To kind of work out the kinks, make sure that, hey, we're actually helping people or the system, the economy, by actually doing it versus, hey, it's new, it's exciting, we can do it. Maybe we've seen crypto and some of the markets going up heavily. Let's just kind of force and rush, right? So I think I'm curious to see how that plays over time and take shape, especially where some people might feel a little bit more comfortable with just say a target date fund and how that will work itself into it and what are the fees that will be associated with all of that for it. So
and I think also like crypto doesn't make it into target date funds, but should they? Like even if it's not direct crypto, now we have crypto ETFs. Like, should that be part of a diversified portfolio? I would argue yes. And I think it varies depending on your target and your time frame. I also think that the vehicles need to change, like private equity, right? Like you commit a certain dollar amount and then they call your capital over time. So if you say, I want to invest $10,000 in this, they might be like, okay, we'll take 1,000 right now. We have this investment. And then you sit and wait. And then they'll tell you like, okay, now we're going to call this much. It's going to this investment. So it takes time. And usually it's around a 5-year window, 3 to 5 year window, depending on how many opportunities they see. That's how they decide right. And then after that, it's like a 5-year window of like harvesting the investments, exiting the investments. And usually there's this long tail. So like typically you can assume you're in the fund for 10 years. This isn't private equity, just a traditional private equity fund. And then usually in that 10th year, you have this like tiny amount left in the fund because there's this like one thing that's left in it or like something where like they can't sell it because these are all private investments and it's not like a stock where you just go to an exchange and sell it. So that's usually what happens. It actually takes like even longer than you expect. And then the fees are charged differently depending on where you are in that life cycle. What I think we need to move toward more is the concept of like a closed end fund, which is like you put your money in and they are looking for the investments. And then maybe that closed end fund becomes this like unit that you can sell. So if I get invested in it and then like, let's say it goes up in value, but like all the investments are still in there. And I say, you know what, Bafi, I actually like, I don't want this anymore. Do you want to buy it from me? And it's like part of an exchange. No, the capital inside of it doesn't change, right? But who owns it will change. And that's where I think we need to get to with these things because it makes it much easier to move from investor to investor, the same way as stock is.
Interesting take. I think as you were kind of explaining that, being able to sell it in that bundle aspect, for some reason it jolted my memory to think about just student loans, how you can basically package some of these loans and just somebody else can invest in it, right? They can purchase your asset.
Right. Your cash flow.
Take all of that. Yeah.
Yeah.
So for those that are listening that might feel like it was a little bit technically challenging or a little bit hard to visualize it, think about what the student loan system and how that can also be bundled and sold.
Yeah.
And just replace it with
right. Because otherwise private equity, like you're just in it. Like that's it. You've made a commitment and like you just have to, you got to wait.
You're kind of locked in.
Yeah.
That's cool. Steph, I'm kind of curious. I'd like to maybe pivot a little bit more to talking about any trends you're noticing, especially with maybe retail investors, such as people like ourselves, or even institutional investors, such as these big banks, maybe JP Morgan, or these big people who are investing with massive amounts of money. I'm curious, like any trends you're noticing between these two different groups, especially right now. I mean, it's pretty clear that the bull market has heated up pretty well. I mean, it seems like we're in a pretty hot territory with this current bull market. So I'm really curious just to get your insights of like what you kind of noticed trend wise of like how these two groups, institutional investors, such as these big banks or these big hedge funds, are kind of moving, and how retail investors, such as ourselves, like what you're noticing, how we're moving. I'd love to get your thoughts because I know you're in it with the data and you're constantly watching these trends. So if there's anything you could share, I think we'd all appreciate that.
I think as far as I can tell, and I don't see like the institutional data, but as far as I can tell, I think there's a lot of skeptics out there right now. And I think right now it's okay to be skeptical, but this entire year, I think a lot of institutions were skeptical. Whereas we saw like when, like, I think what I was talking about this actually yesterday with one of the people who is going to join us at Hood Summit on stage. And he said something that like I've been doing myself in Robinhood strategies, which is historically speaking, when you're investing, you're looking at interest rates, you're looking at earnings, you're looking at valuations. Not that those don't matter anymore. They still do. But the other piece you looked at was the Fed. And like the Fed really, like I used to call any Fed chairman, like Jay Powell is our Fed chairman. He has been for a while. I called him DJ Powell because he was like the market's DJ. Like he like played, he played his song and the markets would like move up or down. And, so I started thinking about how I actually feel like Trump and Bissent have taken over as like the market's DJ as of January. And because of that, like I listen, and this is not political. Like I can agree or disagree personally with what they're doing, but what they say they're going to do is what happens. And I think like the first time I felt that truly was leading up to Liberation Day. I think I really felt like our customers listened to him and believed what he said he was going to do. And I think a lot of market participants who've been in the markets for a long time, I will tell you the moment when I realized something was going on. But I saw in February, markets had reached like a peak. And soon after, then we had a little bit of a dip, and it wasn't driven by like Liberation Day hadn't come or what have you. It was just like a little bit of a dribble down. And I noticed from the trading from our retail customer base, like from our everyday customer investor base, is that they weren't necessarily buying that little dip. And there, I just saw a little bit of a shift. Like, just if you'd been watching the data for a while, that's the only way you could pick it up. And I said, I remember I was on CNBC and I was like, I'm getting cautious in the near term. And, this is right before we were launching Robinhood strategies. Like, I was like, I got to start managing money for people. And I'm like going into this environment where like, I don't know. I actually like getting a little nervous. Mm-hmm. So if someone puts money in our portfolios, like, do I get them fully invested or do I leave some on the side? Because I'm a little nervous. We ended up leaving some on the side, and then later invested it. But I was thinking about how I think our customers started just taking them simply at their word. And I think if you've been in the markets for a while, you analyze the words and you say, well, why would they're not going to do all these tariffs. Like the first time Trump was and he didn't do all these tariffs, they're not going to do all these tariffs. That would be demolishing the economy and the markets. And they don't want to do that. Like, they're still businessmen and they were serious about it, right? So like, I remember a week or so, we had just launched Robinhood strategies and we had some T-bill exposure in the portfolio because I was nervous. But then I remember reading a Politico article and I said, you know what? They're going to go bold. Like they're going to go big. And then they did with that poster outside. And I said, I was like, wow. And the market's tanked and everything. And then obviously I think you saw where the threshold was on their side. And I think it was more in the bond market at that time than the stock market. You watch where the 10-year went. And I think that's where he was like, actually, we can't do this. We got to give people, we got to give people time and companies time and all this stuff. So, and then they put the pause in. And then as soon, I saw our customers starting to buy the dip and then the pause came in. And I remember I was like, oh, the markets jumped. I said, did we miss it? But then the next day, the markets were down one more time before they went up higher. And I was like, let's go. So we added more money from the T-bills into the market and they took off after that. But I think that our customer base is reading those tea leaves because they're not overanalyzing it, right? Like if you're coming from us, you're like, well, why would they say that? And because past politicians have done that. They haven't been as just simply stating what they're going to do. They're always thinking about the impact of stuff. And I feel like Trump and Bissett are like, this is what we're doing. Here's why we're doing it. Take it or leave it.
Do you feel like the effects are becoming more immediate? Like a year ago, the Fed would announce maybe cuts coming up or something like that, but the effects would be very slow. But now, if something is said live, and it's very difficult for retail investors to stay live because you're working against hedge funds and other people that have live news exactly when they happen. So it's difficult for retail investors to know. But would you say that we live in a world now where everything that's said immediately changes the market and it can go more than just 1%? It can be a big drop or a big high, like tomorrow's event, right? The Jackson Hole event. That depends. We're depending so much on just a couple people. What are your thoughts on that?
I think markets move faster than they've ever moved. I think it reacts faster than it's ever reacted. And I think this means two things for the everyday investor. If you're an active trader, you got to watch it because it can change on a dime. So right size your positions, try to get ahead of it. Say, what could happen here? Am I okay with this loss? If this happens, and I do think you as a retail or everyday, I don't like using the word retail, everyday, a regular investor, non-professional, that they are there. I think you actually have the most access we've ever had. And I think you have a benefit. And then I always say everybody could be a professional investor because I think there's stuff that everyday people know that I said this just before I was on another podcast, but I was like, if you live in New York City and you're in finance, you live in this finance bubble and you hear everybody kind of thinks the same way, says the same things, has been trained in similar ways on similar things. And that's why I'm actually feel very blessed to be at Robinhood because I'm still part of it, but I kind of get to be out of it too. But same thing if you're in California and you're in Silicon Valley, you're in the it's this California's tech world that's a little bit of a bubble. Chicago, you're in this futures / commodities maybe world. And then I'm sure there's other worlds in other cities that you guys are aware of. But I think they're the everyday investor can actually separate themselves from those bubbles and say okay, what do I think what do I think of the world? What do I see every day as I'm like walking around? Like, do I see growth coming down? Are the highways packed? Is the, like, are prices going up for me? Like, I feel like there's things you can draw that can put yourself where you can be just as reactive as like a hedge fund. And hedge funds don't, as I said, they're part of a bubble too. So like maybe they're not always getting the same perspective that you have. The other thing I would say is everyday investors, like if you're not an active trader, I don't think you need to be in this daily noise. Like I think it's worse for you to be in this daily noise because you may end up overreacting. And I mean, I'll be honest, like I have to check myself, which is, the other day I'm seeing Palantir go down by a lot, right? It's like, and I'm like, is there something else happening? Like, should I panic in this moment? To be honest. And so I think what you need to do is, I always use this analogy, but if you guys you're driving a car and you're looking for something, so you turn down the radio, like, do you
Just
need to turn
focus
down
a little bit
like,
more? Yeah.
Right? Like is the sound really like affecting your sight? No, but like you need to turn down all of that noise as a long-term investor because you just really need to like you just need to stay disciplined. You need to, when the markets go down, try to save a little more, to add a little more. Like, don't get caught up in it because it probably will hurt you more than help you.
When would you say it's like the best time to rebalance as a long-term investor?
Yeah, I think there's two things to think about. One is taxes when you're rebalancing, because if you do have gains, you might have to pay taxes in the year, if you're selling some stuff that's gone up and maybe you own too much of it. And the second, so just be aware of how much you have to pay and if you can pay it that year, and you can't harvest if you're not harvesting other losses to offset it. A lot of studies have shown that you should never rebalance.
Yeah.
But I actually think it's certainly, to me, a good time to rebalance would be when maybe something is shifted. You're getting closer to some marker in your own life that is changing the way you live. If you are thinking you might lose your job, if you're thinking you might leave your job, if you're thinking you might retire, if you're thinking you might have a kid soon, you might want to buy a house soon. Like if your money's fully invested and you want to buy a house soon, like maybe don't leave all that money up to the market's chance. Like, maybe take some of that down, but make sure, if you're saving for your kids' college, like as it gets closer, you want to be a little more, because you need to pay those bills. Though it's just like, think about those times, I think, in major rebalances.
Yeah, Stephanie, I think you touched on something that is really important. I'm glad you mentioned that. You said that you have to also check yourself and your emotions, right? And for the listeners, despite Stephanie's decades of experience being at the forefront, at the highest level in everything that's happening now, you still have to take inventory of your perspective and emotions. And I think that's a great tip for all the listeners to get that periodic reminder to understand that, hey, it doesn't matter what level you're at, whether you just started investing, you're in the middle of your investment career, or you're senior and you have as much experience as Stephanie herself. You do always have to take that fundamental approach. And we do always preach about long-term investing, which Fernando spoke on briefly as well. But in order to stay the course, you do have to cross the short-term and the mid-term roads, which can be bumpy. And Stephanie did a really good job of giving us a good overview of some of the things happening this year. So I want to focus on the next 6 months briefly with my next question. As she touched on Fed action, president preference versus current Fed actions, right? Geopolitical tension, tariffs still having an impact on markets and the decision-making that takes place. With all the data that your team have, what is the biggest thing that you're excited about for this second half of the year? And what is the biggest thing that you're most skeptical or cautious about for the second half of this year?
So excited and skeptical, right? Both. I'm skeptical about two things. One more near term, which is that we like, if you look back in the history of the market, the worst market by far, and it's not, the worst month in the market by far, and it's not every single year, but it's September. Yeah. And why is that? Why does it have that, right? And somebody once recently said to me, "Oh, we don't have enough data to declare that." But I was like, I don't know. I went back like 45 years. Like that's times 12. That's a lot of data to me. And usually like you only need 30 data points or something like that to declare statistical significance. But why is that? I think you have this like confluence of factors. One, usually like people start to like take time off at the end of August, and especially in the financial markets, like the senior traders go to their houses in the Hamptons and the junior traders are left there. Someone's always like left around, but you've seen it also in like that the week around the holidays in December, like liquidity gets dry. End of August, same thing. And so no one's really putting new positions on. Everyone's like, you know what? I don't know. I'm just not going to worry about the market right now. And I'll worry about it when I get back. Then Labor Day comes, people come back, kids go back to school. And then if you're not in college, you're already in school in college, but there's like, now it's like, okay, reset. Like, I feel like that we've been so much in our heads have been trained to feel like September is like, okay, it's my new year, right? You start reschool, your next grade in September. So I feel like even though December's the end of the year, September's like the beginning of the next year for all of us. So now they come back and they reassess the economic situation right at the time where it's before a Fed meeting. So Fed can't say a word. No one's talking anymore. They have this quiet period. Companies, same thing. We're about to start earnings season at the beginning of October. But they can't, so they go in their quiet periods. They can't say anything. So all you're left with is a little bit of economic data that comes out during that time period. And your techs, proverbially, left unread. Like you're basically like, and I say this is always like that time period, but I think it's the worst in September. If you have like what your significant other goes away for the weekend with their friends and you text them and they don't text you back, you're going to start being like, well, what are they doing? Are they okay? And if they're okay, well, who are they with? Like, and so, that's what I feel like happens in September. And so this is a long explanation for a short time period, but I am worried about that because we also have we're leading up to a Fed meeting that the president has put a lot of pressure on. We've seen 2 Fed governors be replaced. We had a third that resigned, and now they're putting pressure on a 4th because they want rates to be cut. And I know one of the arguments is because rates are the highest interest rate on a federal government level is for T-bills. T-bills are the short term. They're between 4 weeks and 1 year. And that is a large portion of government debt. It's more than 20% is in the short term. And it's the highest interest rate that the government pays. And the Fed, if they cut rates, short-term interest rates will come down. So they want to save money. They're like, we want to pay less. I totally get it. If I had a lot of debt, I'd be like, how can I pay less?
It's like
I need to get myself out of this.
In a way.
Exactly.
It makes total sense. But the Fed wasn't designed to care about that.
Yeah.
The Fed was designed to have a goal of full employment and low inflation. And I think you've got the Fed, and I said this, you've got the Fed coming out of a period where I think they are, as humans, we try to plan for the last disaster. If we go through trauma, we're just like, I cannot let that happen to me ever again. And if you're the Fed governors and you're Jay Powell, you watched all of us pay so much more money than we've ever paid in terms of increase in prices. We had inflation at a peak of 9%. We haven't had that since the late 1970s. So that's the only last time it was that high. So I'm like, they're coming off that saying we cannot put our population through that again. So that's what they care about. They're like, we just can't. And tariffs have introduced an unknown that they just don't know. And it's possible. You saw Walmart earnings today. Walmart earnings showed that they were passing prices through because Walmart earnings showed their inflation went up by 1%, but their margins went up as well, which means they passed the prices on, right? You could draw that conclusion. So I think we will have higher inflation. My only other concern, and this is where I think the Fed, I'm worried that they're not thinking about this, and our job market isn't growing as fast. Maybe that makes sense because we had such hyper growth in the job market for a while. But what if companies are like, okay, you know what? We're not going to raise our prices, but that means we're going to cut costs to keep our margins the same and, to keep our profits the same. And where's the biggest costs? Often it's
SG&A, restructuring.
Your labor market. So I'm worried that they're worried about the end part to the consumer, but are they worried about the job? They're not worried about the job market, but I think they should be a little more worried. So I'm hopeful that they make that turn. And I do think that it would benefit actually to put in what I call insurance cuts, which is 25, 50 basis points just to be like, you know what, if we cut a little bit, it might ensure that we don't go into recession based on these cuts, but based on the tariffs. My longer term concern, sorry, this is a very long answer. My longer term concern over the next 6 months, so maybe like towards the end of the year, is just simply like, do we start to see evidence? Does enough skepticism start to come into the market about some of the valuations that we have on tech companies, given that they're spending so much on AI and we haven't seen the fruits of that yet? Like I'm worried about that. And does it matter for a big investor or for an everyday investor? Yes, because tech companies are 30-40% of just the broad-based indices. So if you're investing through ETFs in broad-based indices like that, if that comes into question, you'll see a dip in the markets.
We definitely don't want to see a repeat of the early 2000s. I think investors kind of keep that in mind of like, yeah, innovation's good, but we still want to see results before we just give an unlimited valuation to any of these companies like NVIDIA or even Palantir, like some of these AI darlings. It's like, we still got to see results being posted. And I mean, luckily, like there is massive amounts of results that they are posting. I mean,
they have huge revenue.
They have huge revenue. They're selling like crazy. But it's just interesting nonetheless. And Steph, that leads me to a quick question. I know we're kind of running up on time, but I want to ask you more just kind of like bring this all together. Like in your career, have you seen the market pay so much attention to one institution or even just one person, such as Jay Powell, or even now we have Trump, where the market pays a lot of attention to what he says because, like you said, he does what he usually says. So the market tries to get ahead of that and reacts very quickly whenever he mentions something. Have you noticed within your career, like the market being so reactive to just one institution or even one person as it is now in 2025?
Yes, when it comes to the Fed, but no, not when it comes to the president. Like never have I ever seen a president or a treasury secretary have this much influence on the market. Obviously, the decisions they make, historical ones have made decisions that will have lasting effects on the economy in the longer term. But I would say like the Fed, right? If you think about the last two recessions we had in 2020, like I'll never forget the day when the Fed was like, we are taking interest rates to zero. Like that day it was like, boom, and the market started lifting and they started buying bonds again because they're like, we have to do it. And then in 2008, they had so many different programs that came out to save any place that had debt that had just overrun, right? Like they had, I forget all the acronyms. It was like TAMP, asset, like there was all these different programs that came from the Fed that the Fed partnered with the government to save like the mortgage, all these things that were defaulting. But that obviously created eventually a ton of change in the regulations for banks and for financial institutions after that, which really did have an impact on profitability of banks longer term. So longer term, maybe Congress had an impact on that, but I'd say in the moment, the Fed definitely has before. And that's why I say like Powell is the market's DJ, but maybe he's handed his decks to Trump and Bissett.
Quick question. So like, would you say, because I know, are you able to talk maybe a little bit about, I know Vila talked about it in our last episode with them, tokenization on crypto, and giving Europe access to US private companies through that. Are you able to maybe touch a little bit on that just for our audience to understand it? Because I know we mentioned it in that episode and we've talked about it before, but we want to kind of get a little more information on it for our audience.
Yeah, I think tokenization generally is easier to do in Europe than it is in the US. I think that will change over time. The SEC has a crypto task force. The president has made it very clear that he wants this place to be the crypto capital of the world. And so I think it's going to get better, but right now it's actually still easier to tokenize an asset in Europe, given just the regulations there. That being said, I think it's definitely on our radar, but we think there might be other avenues to pursue here in the US to provide access to private investments anyway, than through tokenization. In terms of crypto, like I think the regulations they're coming every day and they're partnering closely with financial institutions, listening to what they need to live out what the president has declared. And I think it was about time because it was was way too loose in the crypto world. There were a lot of like, I think one of the problems is like the states were governing crypto, but it was a different rule for every state. And it's still that's still kind of the case. It's kind of insanity because then like if you're a company like us and you're trying to like just provide access to everybody in the country, and then you're like, oh, I can do this here, but I can't do that here, and I can't. And I even see it here in New York. New York's pretty strict, and like there's certain things I can't do it with crypto versus other states. So I think, and like some of them are the opposite rules. Like I know there's this one rule that like California says you have to do this, and New York is like you cannot do this. And so it seems like it's crazy. It's crazy if you think about it. Like, and so you need a baseline of regulations. It's funny, like I think like in some cases like financial institutions are overly regulated, and then like crypto is under-regulated. Like, and that's why I actually think like financial institutions have stayed away from crypto because they were like, we know there's so many rules out there, like we just don't want to touch it because there are no rules. But as gets more rules, it becomes more mainstream. And this has been my take for a while, is that like one of the main tailwinds is the fact that it will become more, maybe not every coin out there, I will tell you, but some of them will become mainstream.
Yeah, I think when we had the episode with Vlad, he definitely touched on some of the complexities in what is allowed in this environment versus not this environment, this country, not this country, and just the challenge and trying to provide access that's a little bit more universal. So I'm really hopeful that as things develop over time with advancement, technology, and more synergy, we're able to kind of get a much better baseline and access across. And I think you guys do a fantastic job of always being transparent, and you coming on here and just sharing just some of that challenges there, even in the crypto space within our own states in the US. I think people can also appreciate the difficulty it is in trying to execute such a daunting goal.
Yeah, well said. Well, hey, Steph, thank you so much for coming on this episode. Before we officially end the episode, where could our listeners find you if they want to dive into more of your insights or learn a little bit more about just how you see the markets moving?
I post on X and Instagram under the handle of Steph Guild NYC. And I have a blog that you can find on the web under learn.robinhood.com. It's called Investors Guild. And also, if you're a Robinhood customer, it's in your like news feed every week.
Awesome stuff. Well, you guys heard it here first. Make sure to go follow her on X. Check out the blog. There's a lot of great resources there. And again, Steph, thanks for taking the time out of your day to come on here, share some of your insights, your thoughts. I learned a lot. It's always nice just to kind of hear from somebody who's deep in the industry, has quite the experience like yourself. So thanks again for coming on. And everybody who's listening, if you found this episode helpful, make sure to leave a quick 5-star review on whatever podcast platform you're listening on. We really appreciate that. And as always, keep stacking assets, and we'll catch you up on the next episode. Have a great rest of your day. Bye-bye.